TD Bank operates under a relentless promise: America's most convenient bank. It offers long hours, open doors 7 days a week, and a family-friendly footprint. It was also highly convenient for the Jiang fentanyl cartel. Between 2012 and 2023, operatives acting on behalf of international drug trafficking organizations walked roughly $670 million in physical cash directly through branch doors. They pushed it across the counter, and the money entered the legitimate financial system without triggering a single alarm. When federal investigators finally dismantled the operation, a low-level branch worker in New York pleaded guilty and faced federal prison time. The polished chief executive officer who oversaw the bank's massive decade-long expansion simply retired. This staggering disparity isn't a breakdown of the justice system. It's the logical outcome of a financial model where the penalty for failure is often cheaper than the price of a lock. The government unraveled the network not by auditing the bank, but by baiting the cartel. Agents from the FBI and DEA constructed an undercover sting operation, posing as cryptocurrency brokers running a conversion service for bulk cash. The Jiang operatives were actively looking to diversify how they laundered their fentanyl proceeds. They reached out to the fake crypto exchange, walking straight into the sting and handing federal agents the exact blueprint of their banking infrastructure. Federal wiretaps captured the mechanics. The investigators recorded the exact street branches the cartel preferred, the specific account numbers they utilized, and the names of the TD Bank employees who were actively bypassing security protocols to process the cash. The wiretaps and logs told a specific story. The cartels hadn't tricked the bank's security systems. They had simply walked through the holes where those systems were supposed to be. This animated diagram illustrates a money laundering tactic known as smurfing. The cartel generates physical cash in massive blocks. To stay under the automated federal reporting thresholds that trigger when large deposits are made, operatives fragment that cash into dozens of smaller individual deposits. The operatives then layer those deposits. They open multiple accounts using real identification and real business registrations. A small retail shop or service company provides a convincing cover to mask the origin of the fragmented cash entering the vault. Wilfredo Aquino was a teller at a TD Bank branch in New York. He became the primary face of street-level corruption in the Department of Justice's charging documents. Aquino processed these fragmented, suspicious deposits, knowing exactly what they were. The price to purchase his cooperation was surprisingly low. He accepted bribes in the form of small cash payouts and hundreds of dollars in Walmart gift cards. Aquino provided the physical entry point for the cartel's money, but a single branch teller cannot override a national bank's automated compliance network. His localized corruption only succeeded because of a catastrophic, invisible failure at the highest levels of the institution. This diagram tracks the total transaction volume operating in the bank's blind spot. Between 2012 and 2023, TD Bank's internal monitoring systems failed to evaluate $18.3 trillion in customer transactions. The bank's automated software actually caught the suspicious patterns and generated red flags. But the compliance department was intentionally starved of modern technology and staff. Tens of thousands of high-risk alerts were cleared without a single investigation because there simply wasn't anyone available to read them. Internal auditors documented this severe lack of resources. They drafted deficiency reports warning the board of directors that the compliance program was failing. The board acknowledged the reports, but repeatedly refused to authorize the funding required to fix the systems. At the October 2024 press conference, the Department of Justice explicitly called this approach a growth strategy. Fully staffing the anti-money laundering department would require capital, and that expense would cut directly into the massive profit margins generated by the unmonitored accounts. The boardroom executives did not accidentally fail to stop the cartels. They ran a standard corporate cost-benefit analysis and deliberately chose not to afford the lock on the door. The reckoning arrived in October 2024. TD Bank formally pleaded guilty to conspiracy to commit money laundering. The Department of Justice handed down a record-breaking $3.09 billion fine, the largest penalty ever issued under the Bank Secrecy Act. Regulators also applied a secondary mechanism called an asset cap. This legally freezes the bank's ability to grow its U.S. retail footprint or expand its balance sheet until the government is satisfied the internal compliance infrastructure actually works. This bar chart measures the historic penalty against the institution's earning power. A $3 billion fine appears devastating until it sits next to the $15 billion in U.S. revenue TD Bank generated in 2023 alone. The punishment amounts to roughly 20 cents on every dollar the bank earned that year. In the cold calculus of corporate finance, a penalty that can be absorbed by a single year's revenue transforms a criminal act into a manageable operating expense. The consequences for the individuals involved follow a very different set of mathematics. Wilfredo Aquino, the teller who facilitated the transactions for gift cards, entered a guilty plea and awaits severe time in a federal prison. Compare Aquino's fate to CEO Bharat Masrani. He presided over the bank's aggressive expansion and the $18.3 trillion compliance failure. When the DOJ investigation concluded, Masrani announced his resignation, citing personal reasons. He departs with 0 criminal charges and his corporate wealth fully intact. This immunity exists due to the deferred prosecution doctrine. Federal prosecutors operate under a legal culture that treats systemic criminal banking by massive, publicly traded American institutions as an opportunity for a corporate financial settlement, rather than a mandate to indict the executives running the operation. Because TD Bank is the 10th largest bank in the country, the government views it as systemically important. Prosecutors calculate that criminally charging top executives could destabilize the broader American financial market. As long as the justice system guarantees that corporate leaders face no personal threat of prison time, the incentive structure will remain untouched. The billion-dollar fines will be paid out of shareholder equity, the bank doors will stay open, and the cartels will effortlessly find their next convenient pipeline.